It's getting harder to find work in the United States. In August 2025, businesses added just 22,000 new jobs, according to the Bureau of Labor Statistics. For an economy as large as America's, that is a strikingly weak number. Historically, there were periods when monthly job gains regularly topped 200,000, but the current pace is far below that. What we are seeing now suggests the labour market is cooling quickly, and some economists warn this could be the early stage of a broader slowdown. A survey by the New York Federal Reserve recently found that less than half of Americans believe they could find a new job within 3 months if they lost their current one. That declining confidence is a stark reminder that downside risks to employment are real. When those risks materialize, they often do so suddenly. Layoffs rise, unemployment ticks up, and consumer spending contracts. The Federal Reserve can attempt to stimulate hiring by lowering interest rates, but that lever only goes so far. Companies are also facing uncertainty on other fronts: global trade disputes, tariffs, immigration policies, and persistent inflation that makes them cautious about adding staff. For many firms, the issue isn't a lack of demand, but the risks and costs associated with hiring in such an unpredictable climate. Since 2022, economists have described the US economy as experiencing rolling recessions, where certain industries weaken even while the broader economy avoids collapse. Manufacturing is one clear example. Employment in that sector has fallen by about 78,000 over the past year. Wholesale trade has also lost jobs, while construction growth has slowed as higher interest rates weigh on housing. By contrast, healthcare and social assistance continue to grow, adding more than 30,000 jobs in August alone. Leisure and hospitality, which had been a strong source of hiring after the pandemic, has plateaued. This creates a mismatch. Workers are available, but not always in the industries that are hiring. Young workers, particularly recent graduates, are feeling the squeeze most in information and tech-related roles. While layoffs in big tech have slowed from the 2022 to 23 wave, job creation in software and information services has not bounced back strongly. At the same time, many entry-level opportunities are appearing in healthcare support and retail, jobs that typically pay less than technology or finance roles. Interest rates are at the center of this story. Since early 2023, the Fed has kept policy rates above 4%, well above many estimates of the neutral rate of around 2.5 to 3%. That stance was designed to bring down inflation, which had spiked in 2022. While inflation has eased, restrictive policy is now weighing on job growth. In June 2025, payrolls actually contracted by 13,000 jobs, the first monthly decline since December 2020. That revision underscored how fragile the labour market has become. Policymakers argue they are now cutting rates from a position of strength. But the weak August report suggests the labour market may already be losing momentum. Lower rates may provide some breathing room, but they cannot fully offset structural pressures such as high federal deficits, global supply chain shifts, or trade disputes. Long-term borrowing costs, like treasury yields, remain elevated, which means companies still face expensive financing even as the Fed eases policy. The sluggish pace of hiring has created political challenges for the White House. Critics argue that policies on trade, tariffs, and immigration have complicated hiring decisions. Tariffs raise costs for manufacturers and importers, while tighter immigration rules have reduced labour supply on industries such as agriculture, construction, and services. Supporters counter that reshoring supply chains and rebalancing trade are necessary long-term moves, even if they cause short-term disruption. Either way, uncertainty around policy direction makes businesses cautious about expanding payroll. Inflation adds another layer of complexity. prices remain above the Fed's 2% target, leaving little room for aggressive rate cuts without risking another inflation flare-up. This balancing act, supporting the job markets without reigniting inflation, is at the heart of today's economic challenge. The US labour market is caught in cross-currents. On one hand, sectors like healthcare and social assistance are still adding jobs. On the other, core industries such as manufacturing, wholesale trade, and construction are stalling or losing ground. Younger workers are finding it harder to enter high-paying fields, while many employers hesitate to commit to long-term hiring. What emerges is not a simple story of jobs disappearing everywhere, but rather a picture of slowing job creation, sectoral imbalances, and rising uncertainty. The Federal Reserve can nudge conditions with interest rate moves, but it cannot resolve deeper issues tied to trade policy, deficits, or structural changes in the economy. Until businesses regain confidence, whether through more stable policy, lower borrowing costs, or clearer global conditions, the job market is likely to remain fragile. For many Americans, especially those just starting out, finding work will continue to feel harder than it has in years. If you found this update helpful, don't forget to like, comment, and subscribe for more updates.